Hello everyone. This is the last learning objective this week. Thus far, we have looked at momentum and value investing, but there are a range of other factors that can be used by investors that align with various different investment philosophies in terms of how investors view markets are working. So in this learning objective, we are going to look at both the low volatility and the quality smart beta factors, both of which are often used in conjunction with value investing. Low volatility, first of all, while the CAPM assumes that investors can borrow and invest at the risk-free rate, we know that in practice the cost of borrowing may be higher than interest rate that you can receive on an investment. So what this means is that while the capital allocation line in theory a straight line, in practice it can be a king line. We discussed it before. And if that line is kinked, we might actually find is that in lieu of leverage, investor may actually have a preference to invest in risky assets rather than investing in the optimal risky portfolio and levering up along the capital allocation line. So what we might find is that there is an over demand for high volatility stocks because on this issue around the preference for high risk assets. Because of the inability or difficulty to leverage up with the optimal risky portfolio that pushes the price of higher volatility stocks up relative to their fundamental value. On the other hand, the price of low volatility stocks is lower and hence the expected return on low volatility stock is higher compared to high volatility stocks. So there is a smart beta factor whereby investors look at low volatility by saying that because of these mechanics of the market, because of the potential preference for high volatility risky assets, given some of the limitations of the theory, which suggests you can just always invest in optimal risky portfolio on leverage, there may be a world in which low volatility investing can achieve higher return and investors seek to exploit this. There is a range of different ways that investor can try to come up with low volatility strategies. In simple, investor will try to invest in low volatility stocks compared to high volatility stocks. So let's have a look at a few different approaches that are often used. Basically, what we have got here are the abnormal returns are on various different low volatility strategies compared with that of market returns across 50 or so years from 1967 to 2011. So the four different strategies we look at here from left to right, the S&P low volatility stocks, that is just looking at the stocks within the market that on average have lower volatility and are screening to hold those particular stocks in your portfolio. You can see that that particular portfolio, I mean the portfolio that includes low volatility stocks, tend to outperform the overall market index by about 1.59%. Couple of other strategies are looking at weighting stocks according to the inverse of their measure of risk. So the one approach is whereby you're looking at stocks according to the inverse of its beta. So if you have got a higher beta stock, it means that it is high risky. The inverse of beta will mean it will have a very low weighting, whereas low beta stock will have a very high weighting. So this particular approach also generates a positive abnormal return of about 1.73%. Similarly, you can look at a risk as being the volatility or a standard deviation of return. And in this approach, you take inverse of a volatility, I mean inverse of a standard deviation of return, and use that as a mechanism for weighting the stocks. So the stocks that have higher standard deviation and you take 1 by inverse, it means that those stocks will get higher weight, and the other stocks that have low volatility will get low weight. I'm sorry, therefore low volatility stocks will have higher weighting and higher volatility stocks will have lower weighting. And you can see that this approach generates an abnormal return of 1.53%. And last of all is this approach seeks to the optimization calculation that we have previously looked at. And we come up with a similar simulated minimum variance portfolio we have previously seen. And often what you will see that use the historic covariance matrix in order to identify that particular portfolio and hold that minimum variance portfolio instead of holding the optimal risky portfolio. And evidence suggests that minimum variance portfolio outperforms the market by 1.84%. So as well as looking at low volatility factors, another alternative smart beta factor that investors may decide to exploit as part of their investment philosophy are several factors relating to farm quality. Asnes, Fraggini, and Patterson in 2014 argued that investors did not fully incorporate farm quality into prices, resulting in high quality farms being underpriced and subsequently generating positive abnormal returns. But probably the quality is a nebulous concept, not something is very clearly defined. So what we have to do is to come up with a measure by which we can identify the quality of the farm. A range of different measures of farm quality has been proposed in the literature, and these include asset growth, accruals, net share issuance, profitability, and corporate governance. So the first one is asset growth. Several studies have identified that farms that grow an extremely fast rate, farms that have high growth from one year to another, tend to subsequently have negative returns. The argument here is that the corporate events that are associated with a high asset expansion may be detrimental to farms, such as like a large amount of leverage. Therefore, the argument is that high quality farms are not the farms that have very high asset growth. Rather, high quality farms are the farms that have relatively lower growth in asset. So you should not invest in farms with extremely high growth rate in asset. And consistent with this idea, Cooper, Gallon, and Schill demonstrate a strong negative relationship between asset growth and subsequent returns. And this association is confirmed by another paper of Gray and Johnston in Australia in 2011. So you can see this example from Cooper, Gulen, and Schill. So what they did is they actually ranked stocks on the basis of the asset growth in the company, and they have divided them in 10 decile. So decile 1 includes the stocks that have low growth rate in asset, and sorry, and decile 10 include stocks that have high growth rate in assets. And if you carefully look, you can see that stock returns monotonically decrease from decile 1 to decile 10. So indicates that decile 1, that includes low growth rate in asset, substantially outperform the decile 10 that has the companies with high growth rate in asset. And you can see that the decile 1, that includes the companies with low growth rate in assets, generates an average monthly return of about 2%, whereas the decile 10, that includes companies with high growth rate in assets, generates only an average monthly return of about 0.3%. So this clearly indicates that the low growth asset is an indication of quality compared to high growth in asset in the companies. Another indication of farm quality might be accounting accruals. The idea of accounting accruals is based on the accrual accounting system, whereby revenues and expenses are recognized on financial statements as soon as they are incurred, as opposed to when the cash flow takes place. Therefore, at the end of every year, the accounting profit that is recorded in financial statement is basically a combination of net cash flow plus the net accrual balance. The accruals are revenues that are recognized before cash flows come in. So for example, you would recognize the revenue when invoice is drawn as opposed to when an invoice is paid out. Similar explanation holds for expenses as well. Now the argument for accounting accrual is that if you decompose total profit into net cash flow and accrual component, net cash flow is more informative of actual economic performance of a firm, whereas the accrual component of profit is basically a component that can potentially be manipulated by firms and accountants. So the idea of accounting accrual is that those firms who report net profit figures where a large portion of the profit is through accruals rather than cash flows should subsequently underperform. Whereas those firms who report profits that are largely made up of net cash flows and a smaller portion of accruals, those firms should perform better in the subsequent period. So this is an evidence taken from Havzella et al. In 2011, who used US data to examine 81,526 firms over the period of 1989 to 2018. So what they did is they ranked all these firms on a yearly basis based on the proportion of the positive accruals, I mean net positive accruals in their profit. And they have divided these firms in deciles. And here, decile 1 includes the companies that has low net positive accruals, and decile 10 includes the firms that have high net positive accruals. And you can see that the decile that have firms with low net positive accruals, that means the firms that generate profit whose main component is cash flow rather than accruals, they generate a substantially high return compared to decile 10 that includes companies that have a component in their net profit which is more of accruals rather than cash flows. Another measure of quality is share issuance. There are a range of studies that basically argue that firms might time the market, that is, they issue shares where they perceive that their share is currently underpriced, and they will buy back share where they perceive that the share is underpriced. Therefore, the argument here is an investment strategy where you buy stocks when firms engaging in buybacks and sell stocks when firms issue shares. So if you look at evidence, this is an Australian evidence between the period of 1988 to 2012 taken from Amelia Doherty and Stone 2015 paper, and they have divided Australian firms in the three separate portfolios where this one has a negative to zero share issuance, and this group of firms has low share issuance, and this group of firm has high share issuance. And you can see that the group of firms that has negative or zero share issuance, I mean this firm basically have more buybacks compared to share issue, generate substantially higher return compared to the group of firms that have higher share issuance. So you can see that in an investment strategy of buying stocks that has negative or zero share issuance, or the firms that have buying stocks that the firms that have higher buybacks, and selling stocks that have higher share issuance and less amount of buybacks will generate a substantially higher abnormal return. The last quality screen that might be considered is to look at the measure of firm's quality by focusing on the management of the firm, in particular looking at the internal corporate governance characteristics. Agency theory suggests that potential costs that can be incurred due to the separation of ownership and management, whereby when there is a good corporate governance practices in place, these costs can be mitigated. Therefore, firms that have poor corporate governance might expect higher agency costs and hence poor subsequent return performance, whereas firms with a strong corporate governance should arguably perform better in the market. Here is an evidence of corporate governance and stock returns. Here, the stocks were divided into 5 quintiles. And you can see that this quintile includes the firms that have poor corporate governance, and this quintile includes the firms that have improved corporate governance or strong corporate governance. And you can see that the quintile that includes firms with higher corporate governance or the good corporate governance generates a return which is about 12%, whereas the quintile that includes stocks that have poor corporate governance generates a return of only about 4%. So there is a substantial difference between the group of companies that have a strong corporate governance and the group of companies that have poor corporate governance. So we can say that in an investment strategy of buying stocks of the companies that have good corporate governance, and selling stocks of the companies that have bad corporate governance can generate a substantially higher return. Just to sum up, in terms of looking at low volatility and quality, we know that we have seen before, value investing simply seeks to identify cheap stocks. So it's basically coming up with some measure of fundamental value of the firm and comparing that to the market price. However, studies have argued that just identifying cheap stocks is not enough. What we might want to do is to combine value with some of the other factors, maybe combining value with low volatility or quality. Asnes, Fragini, and Patterson in 2013 report that combining quality and value together, which they call quality at a reasonable cost, results in positive alpha that is higher than either value or quality investment strategies alone. So consistent with this idea of combining value with other factors, Standard and Poor has actually introduced the S&P GIBI index. Basically, this is a rules-based index that combines low volatility investing with value investing. Furthermore, Asnes, Masquith, and Patterson in 2012 argued that there might be some merit to combining value and momentum together, given the high abnormal returns that are generated by both these investment strategies and the fact that these two strategies tend to be negatively correlated with each other. Hence, there could be diversification benefits by having these two investment strategies together. So in short, while there is a strong evidence in favor of value investing, and you can see a strong amount of academic evidence that reports the abnormal returns that are generated by value investment strategies, potentially an optimal investment strategy can involve not only value, but combining value with some other factors such as quality or low volatility or momentum. That's the end of our discussion on this learning objective. Thank you very much.